looking at the ungluing of this so tight relationship we've seen for so long between, on the daily basis, the nominal rate and gold prices. Something has changed.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is Lobo Tiggre from the Independent Speculator. Lobo, thank you so much for joining us today.
Thank you for having me back again.
It's great to have you. And I wanted to discuss your recent article, and also in your email newsletter, you also have a post about this. There's a correlation that's been going on for a while between interest rates and gold. And essentially, gold is negatively correlated with real interest rates. However, we're seeing now it being correlated with the dollar index instead, or negatively correlated with the dollar index. Can you expand on kind of the shift we're seeing right now?
Sure. Well, the first thing I have to stress is that this is fairly early stage. We don't have, decades-long charts that support some thesis as solidly as the gold versus real rates relationship, which is not just some while, it's the entire while that's relevant. The relationship goes all the way back to 71 when, Richard Nixon severed the last vestiges of the gold standard from the dollar. And in that time period, gold responds to many things, geopolitical blowups and yes, inflation and other things. But the number one explaining variable is real rates. And when they go negative, as they did in the 70s, and this is worth stressing because people talk about high inflation. Well, there were also high interest rates in the 70s, but gold still went up. So it's not just interest rates, it's real rates. And so you had high rates, but you had higher inflation, and that made real rates negative and gold up. I'm doing all this arm wiggling. My version of geology arm waving. So that's the context. And this has been the single most explanatory variable in the price of gold for 50 years, the entire time that gold wasn't a set amount of dollars, i.e. money in circulation or quasi-circulation. So that's a really strong relationship. And just in the last few weeks, partly this year, if you look at it the last couple of months, actually, we're starting to see that instead of a mirror image, Rorschach type variation between interest rates and as a proxy, nominal rates stand as a proxy for real rates because CPI is only adjusted once a month. So between that monthly thing, you can only guess what the real rate is, and you do that by taking nominal rates and subtracting CPI. So on a day-to-day basis, you'll see gold wiggle inversely with the nominal rate. And particularly the 10-year is one that markets look at a lot, the so-called benchmark 10-year rate. But this year we're seeing that actually the lines, instead of gold being so inversely directly wiggling contrary to the nominal 10-year, it's wiggling with the DXY, with the dollar as a foreign exchange tool. Now, in some ways, this might seem, sorry, I'm going on real long, but we'll encapsulate this. In some ways, this might seem like a no-brainer, right? Gold is priced in dollars. Gold should be inversely related with the dollar, and it generally is. But for all these decades, people have been scratching their heads like, why doesn't gold relate more inversely directly to the dollar? And the reason for that is that the so-called strength of the dollar is hard to measure. I mean, I think realistically it should be measured by inflation, but that's not how people look at the dollar or any currency. They look at it in the foreign exchange markets. So you have periods where the dollar looks strong, right? The dollar is rising. It doesn't mean the dollar is actually strong. It just means the other currencies are crappier. Can I say that on TV? So the dollar is losing the race to the bottom and therefore looks strong. That's not real strength. And that doesn't relate to gold. So the dollar itself has been, less useful as a direct guide in the short term versus gold. It hasn't correlated as well as real rates. So what we're seeing in the last couple of months, really this year, is that the relationship between gold and nominal rates as a proxy for real rates is getting fuzzy. It's getting weaker. It's still there, but there's a lot more noise. Whereas the relationship between gold and the DXY as a proxy for the dollar is getting much stronger, much more closely. Even on a day-to-day basis, you'll see that gold and the dollar's lines look much more like mirror images than gold on real rates. Not every day, but pretty consistently so far this year. And what does this mean? Here I can only theorize, right? I don't know this for a fact. I can't ask everybody in the marketplace, why are you doing this? But my thought is that, one, traders in New York and London, these places, that people who trade these futures contracts, are getting the message that nominal rates and CPI are not giving them the real data they need. They're getting as cautious and suspicious as we gold bugs about this transitory story, and they're looking for other measures. Their algorithms are not being programmed, or not all of them anyway, are not being programmed to knee-jerk react to nominal rates as being a reason to buy or sell gold when they fluctuate. And maybe more of them are programming the dollar directly now, since there's a reason to discount the information coming on inflation. That's one aspect. I think another aspect is you just look at the overall situation. You look at the money printing, the race to the bottom. I think there's evidence that suggests that large institutional players, sovereign wealth funds, not just China and Russia that are not enamored with the dollar, but the broader picture out there of international money, big family offices. I think there's serious money that, frankly, they don't care whether gold pays interest rates or not anymore. They are worried about the dollar. They see the problems with what's happening in the United States, the monetary and fiscal policy, what that implies for the dollar. And so I think you're starting to see larger players. I can't prove this. It's my theory, my explanation for what the data is saying. The data just shows a relationship. My interpretation is traders discounting inflation information as being unreliable, and large institutions saying they don't really care about interest rates so much anymore. They're worried about the dollar. They want something safe that isn't the dollar. They're not all ready to jump on Bitcoin yet. There is something else, though, that has worked for thousands of years. And so that's what I think this data is suggesting to us. No, not suggesting. I don't want to be mealy-mouthed here. That's what I think the data hints at right now.
Now, with respect to that, I mean, it seems like you're saying people are distrusting the CPI and real interest rate data. So why do you think they'd be distrusting that right now?
Just go to the store. Well, partly it's that even if I'm not a gold bug who distrusts everything the government says, I'm just a run-of-the-mill trader on Wall Street. But I'm looking at data that's only updated once a month, whereas I'm also getting headlines on a daily basis about how high inflation is. And you're looking at the structural issues, the broken supply chains. I just saw a story yesterday about how Christmas is expected to be impacted at the end of this year by these still broken supply chains and the backups and just trying to get back to normal in China. And you look at the commodities prices, and okay, they rose up and they're doing some correction and so on. They're not all going back down to where they were. Commodities prices are high. Those are inputs. Your costs for making stuff are staying elevated. So you just look at all this information and then you get transitory, don't worry about it. It's all going away. And I think even if you're not, a hard money Austrian economist, gold bug type person, you have to look at that and say, well, gee, maybe these models and the variables that we've input into them over the last years, maybe they don't entirely apply in the current circumstance. I can't prove this. I have no best friends trading futures so that I could call them up and ask them. Maybe Jeff Christian could, but I could only say that looking at the ungluing of this so tight relationship we've seen for so long between, on the daily basis, the nominal rate and gold prices, something has changed. And in particularly that knee-jerk reaction, which is not a need, actually, it's a program, it's software, it's an algorithmic reaction. The fact that that's changing to me is very optimistic because, those algos, they don't read the headlines. They don't care about the fundamentals that I care about and probably most of the audience cares about. But if the traders are starting to say, wait, we can't trust these old algorithms. We need to adjust for reality now. Well, that's on our side because reality is on our side.
Now, with respect to the CPI, you recently wrote an article on this and how really this argument that people have made that really gold is not an inflation hedge, it doesn't correlate with the CPI, That argument is wrong. The issue is not with gold, it's with the CPI. That CPI is not measuring inflation correctly. Can you expand on this?
Sure. Well, that's part of the picture. I'm a long-term skeptic of the CPI for reasons that many of the audience don't need explained. But that's not all of it. Because if you look at what CPI supposedly measures, of course it does measure some price inflation. There are still prices in there. It's not just totally made up out of la-la land. They are tracking prices. Whether the adjustments are wrong and all these things, that's a debate we don't need to get into. So I'm not totally dismissing CPI. And by the way, even if I did think CPI was complete bunk, I can't ignore it entirely as an investor because, again, those traders, those people on the COMEX and LBMA, they look at CPI and they put that into their trading programs. So if I'm just going to close my eyes and not look at CPI, then I'm going to be flying blind without the data that influences the prices that people quote for metals. So can't just ignore it. But that's not entirely the picture here. It's not just that CPI is bunk. If you look at the correlation over the last 10 years, right, there actually is almost no correlation between gold and CPI. So that's math. That's not just a made-up thing. That's actually there. But how can that be? How can there be no correlation? Well, if you look over the last 50 years, there is, right? So partly it's just the time frame. Partly we had a period of very low CPI measured inflation over the last 10 years, right? Poor Mario Draghi couldn't get his 2% in Europe, and poor Powell and Yellen couldn't get their 2% in the United States. So you had very low inflation, and you had gold prices go up and down, so that it makes sense mathematically to say that there's little or no relationship there. But that doesn't mean there's no relationship. In the first place, gold tends to move with expectations. Like people see what's coming. People see it now. Gold is up this year now, and it was up before inflation moved because people could see it coming. So if you think about that, what happens to the math? What happens to the correlation? If gold moves before inflation, well, there's no correlation there. And then if afterwards inflation catches up, but gold's already priced it in, well, then there's no correlation there. So you say, oh, there's no correlation. But that doesn't mean that gold actually didn't do its job as an inflation hedge. And so part of the answer is just CPI is unreliable. Part of the answer is that one leads the other. And so that you kind of have to, if you wanted to really do it, you would adjust for those time frames. And the big answer, the bottom line, there's a chart on that article that's available for free on the website, is if you look at the big picture, that most relevant of time frames from 1971 till now that we started this conversation on, you can see the value of the dollar, purchasing value of the dollar going down, and gold going up, right? So that great big X on the chart tells you that it's an artificial construct. When these sources, I saw it on CNBC the other day, other places, there's a lot of people out there saying, oh, there's no correlation between gold and inflation. Well, there's artificial reasons for that. And the reality is, over time, we all know that over the centuries, gold holds its value, and paper money, fiat money, money carved on sticks, money in cowrie shop, all kinds of other monies go the way of the dodo, and gold still holds value.
What is your perspective on this? Because I've heard this argument as well, that gold, yes, it holds its value, but so do other commodities, right? It does eventually catch up with inflation, but so do all other commodities. So your perspective on that?
Several things. One is that I don't buy gold as a speculation. Like I'm not investing in gold with my speculative portfolio because I think inflation is going to drive gold prices higher. For that kind of thing, I invest in the stocks. They give me much more leverage. And if the idea is to make money on market fluctuations and market misallocations and the correction of these errors, then the way to do that is with the stocks. I buy gold bullion and silver bullion because it is physical value. It is a financial asset for which I can be long, and there is no short counterparty. And what's different from that, your point about this question is correct. Other things hold on to value. A house still has value. And prices go up, prices go down. I can still live in my house, right? It still has the same number of rooms, same number of bathrooms. I can sleep in there, right? It has a utility to me, and that underpins its value. Whatever the prices do, it's still a house. Same is true for an ounce of gold in my hand. Whatever happens to prices or markets or whatever, it's still an ounce of gold. It could still be turned into X amount of jewelry or X amount of electronic gadgets. It is different, though, in that gold is uniquely recognizable, a uniquely compact form of value, uniquely resistant to corrosion in a physical sense, as well as in the monetary sense. So it has special properties that make it particularly useful and more liquid than other real things. I just had a person on my Twitter feed this morning who responded to this inflation question and a jibe I made about Powell. And he said, okay, so if it's not transitory, what do you protect yourself with? And I guess he wanted me to say gold, and of course that is one thing. But my answer was actually real assets, which fits with your question. Of course, if you see destruction of fiat currencies, then anything real is going to do well compared to these not real imaginary things that we use because governments pass laws telling us to. Absent that, the market would choose something else. It always did. So what I'm saying is, yes, I agree. Sure, copper's up for a reason. Everything else is up for a reason. I'm happy to have a house and not be. I haven't completely paid it off yet, so I shouldn't say that. But that's a real asset. The difference is, and the reason why I want to have bullion as well, is because it's liquid, it's easy, it's very concentrated, but it's still long-term savings, Elijah. I don't buy. I like coins rather than bars. They're more recognizable. I don't buy that because I'm thinking I'm going to sell it next month. I'm buying that because 10 years from now, 20 years from now, if I ever needed money urgently, that would still have value. Whereas anything else, who knows? Or it might be hard to sell. In times of trouble, if something goes really upside down with the global economy, real trouble, good luck selling your big ranch in Colorado, right? Or something like that. Or you're going to sell it for pennies on the dollar. Whereas I can liquidate my bullion if I have to. And I've personally experienced that in my life.
I think that's such a good point. And we've talked about this before, how gold and especially silver throughout history have been money. So that's really the distinction between gold and silver and other commodities. And it has that liquidity, as you mentioned. Right.
Yeah. The word for money in many languages is silver. And if not the official word, the slang for it is silver. And silver's convenient in that it's got less value than gold packed in the same space. So for making change, basically, it's useful to have silver around. But gold for long-term storage of value, it's just hard to beat. It's got all those things that Aristotle talked about thousands of years ago, right? And it's so recognizable, the yellow metal. We talk about the other yellow metal, but that's uranium oxide. It's not actually, uranium itself is gray. Vanadium, by the way, the oxide is also yellow. So you could talk about three yellow metals, but those other metals are not yellow. Gold is recognizable. Okay, it's possible to put tungsten wrapped in gold or something. It's possible to spoof people with gold, but it's not easy and it's not cheap, and it's not the sort of thing that the average person needs to worry about. You go down to your local coin shop, and they have tested these things, or they're slabbed. It's an easy way for the average person who isn't a professional or isn't a banker and so on to have highly liquid, long-term savings that are proof of any level of idiocy that governments go to.
All right. Well, Lobo, Tiggre, really, really appreciate your time today and all the insights that you shared with our viewers. Before we let you go, where can our viewers find you online, and any last thoughts you'd like to add?
Thank you for that. Last thoughts. I have one really key one, but before I go there, the invite, independentspeculator.com. Thanks for that. There's lots of free educational content out there. Obviously, I offer it hoping to do business with you in the future. But the free stuff is good. I work really hard on it and put as much value as I can into it. And we don't spam our readers. If you sign up for our free weekly digest, it has original content not published anywhere else, and you get one email per week, not a flood of advertisements. So I do hope you'll sign up for that. In terms of parting thoughts here, the one thing to really keep in mind is you and I speak, I don't know when this goes live, Elijah, but the Fed is meeting. It's Fed week. Who knows what will happen? Markets look confused. Things are up, down, sideways, kind of more down than up. I think markets are worried. Investors are worried that the Fed might not be quite so easy, might thinking about snatching that punch bowl away. I'm not going to predict exactly what's going to happen. Well, I will say, I think a major policy change, or even any substantial policy change, is very unlikely. But just the tea leaf, of the oracle's cup there, when Powell puts his cup down and everybody looks over the tea leaves of words. What did he say? What does it mean? Oh, he changed happy to glad. I think we'll see a lot of that this week. Expect a lot of volatility. I don't expect serious policy changes, but the changes in the verbiage could really rattle the markets. And ultimately, despite any short-term volatility, I think that will be good for gold and silver. And I'll leave it at that.
All right, Lobo Tiggre, if our viewers would like to hear more of these interviews with you or any of our other guests, they can go to libertyandfinance.com. In the left-hand corner, sign up for our free email newsletter. Once again, Lobo, thank you so much for your time, and God bless.
Thank you, Elijah.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded for physical delivery, vault storage, or precious metals IRAs. Excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.